Welcome everyone to tonight's asset protection webinar. We are delighted to have Scott Estill back with us. As most of you know, Scott is a former senior trial attorney with the IRS. He spent several years with them, and since then he's been in his own practice for over 20 years, helping people navigate and with such clarity as a tax attorney, as an author of multiple books, so many articles and newsletters, and we are thrilled to have Scott here. And so before we turn time over to him, wanted to remind, there's quite a few of you that were on our webinar last week with Mike Koval, taught an amazing webinar. That's available on our website if you missed that. Investor strategies for this market especially. And he gave some really, really good tips. And then he invited several people, I don't know, 20 or so people, to attend a class, a workshop that begins this Saturday. So don't forget that if you've received that invitation and if you signed up to attend that. And next week we won't have a webinar. After that, we're talking advanced planning strategies using statutory trust. For those of you, especially in California, that don't like that $800 filing fee every year for LLCs, corporations, limited partnerships, you'll want to be on this call. It's an advanced workaround for that we have private letter rulings from the California Franchise Tax Board saying, yep, this is approved. And so some really good ideas, especially for Californians, but anybody interested in asset protection might want to be on that call. Following that, we've got Jill Banner and Roberta Hootie talking about some advanced retirement strategies that they see people using. Jill is the president of the IRA or iPlan group, and which is a custodian for millions and millions of dollars of IRA. I don't know how many thousands of accounts, but we've asked her to look at the ones that are performing really well and to give us kind of an update on what's happening in retirement accounts, where people are making money. So that should be an interesting class. The next summit that we have coming up is coming February 22nd, 23rd, 24th. It's actually 4 weeks from yesterday. It's a Monday, Tuesday, Wednesday class. We are so excited, and we're putting together the agenda right now for that. We've got an exciting lineup. This is going to be a really good class. We've got Bill Danko coming back. Scott Estill will be on, and we're securing and putting time slots by everyone's name. So the agenda is a work in progress, but a very good sample will be on our website at protectwealth.com, and you can register for the class at that time. And before the beginning of every year, we get a lot of interesting phone calls at our hotline, and so I wanted to remind you of something that we teach over and over and over again. And that is the effect of a proper asset protection plan is about lowering your financial profile. It's about reducing your taxes and discouraging lawsuits. It's not about creating secrecy, hiding assets, dodging taxes. We are not here to teach tax evasion strategies. We are here to teach here's how to stay legal and compliant with the IRS. You may not like everything that the IRS does or that Congress passes, but here's how to stay compliant. And so with that, I'm not going to read the whole disclaimer, but we're here to teach practical strategies to reduce your taxes. How those strategies apply is really for you and a tax professional to sit down with and discuss. Not everything that we discuss tonight or on any of our webinars will apply to you directly, but we hope that the majority, or at least a big part, does, and you take advantage of the things that are applicable to you. And so with that, I'm so excited Scott, I'm so excited to have you on. Thank you for for agreeing to be here. There's so much interest in what's going to happen and how do we plan when Congress really is kind of in a quaffle themselves. They're not sure where we're going. And it makes planning for this year and future years so difficult. Scott, thank you for adding clarity. And again, if you haven't seen Scott live, we, okay, it may not happen this time at our live stream event, but Scott has been a regular for almost 20 years at our 3-day summit. We're so delighted to have him as a friend and as a partner for our students that they can rely on. So Scott, let's turn time over to you. And I think the format, if you have questions, Scott's put them into the chat screen. Wait, in the Q&A, in the Q&A section, not in the chat screen, excuse me. And we'll get to as many of those as we can as time permits. We plan to go till about 7:45 Mountain Time. So about an hour and 15 minutes. And so we'll get to as much as we can. But as we go through Scott's presentation, you'll find that he's laid it out in a very logical, sequential manner, I think, to be able to answer most of the questions that you have. As you do have questions, we ask that they be non-specific and things that will relate to other people on the call, not specific to, well, my aunt's dog got into, it can't be specific. It has to be general enough for everyone on the call to have an interest in. So we appreciate your questions. We're here to answer questions. But Scott, we're going to turn time over to you. And thank you again so much for your time and being here. We appreciate you.
Thank you, Don. Thank you so much for having me. Just to make sure, do we have the screen correct here now as far as sharing my screen?
Scott, you're going to want to hit display settings up on the very top there and just swap presenter view so we actually see your slides. So, yep, right there. Yep. Swap. There you go. Yep. Perfect.
And now we're in.
You're in.
We're in.
All right. Thank you so much. All right. Well, like Don mentioned here tonight, what I'd like to do for the next 45 minutes to an hour or so is go over some of my thoughts as to what we should be doing this year for taxes in 2021, what we need to be looking at potentially for next year. I know we're barely into 2021 and I'm already talking about 22, but I think we have to look at both years in sort of connection with each other and formulate a game plan based on some of the things that I think are going to happen and some of the things that have already happened. And so, with that in mind, like Don mentioned, not everything that I'm going to talk about here applies to everybody, but it is sort of general tax strategies, but hopefully it'll give you some thoughts as to, these are some strategies that I need to be thinking about. Again, not only for this year, but for the following year as well. We have a lot of different tax changes and tax law changes, I guess, coming about from different places, in the sense that, back maybe 6 months ago or so, doesn't seem quite that long ago, but the CARES Act came out, and that was the initial stimulus act that came out again back in 2020. And a further follow-up to that, a bunch of tax law changes came out in December, so just about a month or so ago, with the December stimulus. On top of that, we're going to see additional CARES Act stimulus, whatever you want to call it. So this is not the end of the stimulus checks or the stimulus program by any stretch of the imagination. So we've got round one, we've got round two already underway here and in the books, but I think we're going to see round three coming up real soon, and likely a round four even at some point down the road. So Biden is talking about I think it's $1.9 trillion stimulus package, and whether he has the full support in Congress or not, we are going to get some additional changes, and with that are going to come some of the tax changes. So, let's just take a look just real quick at some of the things that we need to be aware of for this year, when we're going through it. This is round one of the economic stimulus payments. And if you didn't actually receive this, but you're entitled to get it, but you didn't get it for whatever reason, you will be able to file for a credit when you file the tax return for last year. So sometime in, say March, April, May, I think we're going to see a lot more people filing earlier than normal, just because of the amount of credits that are available, whether it was this round one here or the round two. Notice here, though, that the very last part, the amount of income here, or excuse me, the amount of the stimulus payment is not taxable income. So this has been something that's been a cause of confusion, I think, out there. I've gotten a lot of questions on different events when I've been speaking in the last month or so, unfortunately still virtually, but a lot of questions about, well, I got to pay tax on that. And no, actually, you don't need to pay tax. So on round one, we could get this $1,200 per person, double that for a married couple. Round two, that just came out again about a month or so ago, drops it down. So now we're talking about $600 instead of $1,200. Including the children here, same phase out supply. So this is adjusted gross income. But again, this tax credit here, this $600 per family member. So if you have a husband, wife, and two kids, you could be getting a $2,400 credit. But on something like this, again, not taxable income. So as this slide shows, and this is going to be based on either 19 or 20, you can see up there. So obviously, if your income was high in 19 but low in 20, when you file your 2020 tax return, you may kick in and qualify for these credits. So this purple color here was round one, and the yellow color is what we saw just passed again a few weeks ago. So, and you can qualify for both of these. So if I'm a single person and my adjusted gross income, let's say was 60 grand in 2019, I'm going to be able to qualify for both of these amounts. And let's say that I received this one, but I never received my $600 check. I can now claim this on my tax return. So it's a question of, am I going to get this as an advance credit? Meaning, am I going to get the check in the mail type of thing, the debit card, or the automatic deposit into my bank account? And if not, and I qualify for it, again, make sure that you and your preparer are on the same page, that you understand exactly what it takes to be able to qualify for this credit, because it could be substantial. Certainly if you're married, and definitely if you have minor children under 17, could be a real big deal. So again, make sure that you and your preparer are on the same page here. I'm talking about gifts, and I pulled these slides even from my last webinar that I did here for Don and Protect Wealth, in that, in the end of the year, I want to talk about income tax and estate planning and what have you, but we wanted to look at making annual gifts at the end of the year, at the end of 2020. I also want to encourage you to look at making annual gifts early. So for 2021, you can make the gifts now. And so you don't have to wait to the end of the year or whatever. Realize that when you make these gifts, that if, as long as it's not more than $15,000 per person per year, $30,000 for a married couple then can be given anybody that they want this amount of money. Nobody knows about this, in the sense that it's not reported on any gift tax return or anything else. Now, we want to document the gift, but I like being able to use this gifting strategy early, and especially in a year like this year, where, I don't have a clue really what's going to happen with taxes any more than anybody else does. There's going to be tax changes, yes. To what degree, to what severity, to who's going to end up paying, who's going to benefit, we're just not terribly sure about all of that right now. But at least with the gifts, we can make these gifts now, So effective as of today. And I'm not talking about qualified tuition or medical expenses. I'm just talking about making an outright gift. The benefit here is that this also, here at the very bottom, removes the asset from your estate and also removes the appreciation on that asset from your estate as well. What do I mean? Well, let's say that you make a gift of $15,000 and that $15,000 turns into $20,000 at the end of the year. That $5,000 is never going to be taxed to you. It's going to be taxed to whoever receives the gift, presumably at a much lower tax rate. So again, it's something that I like to look at from the perspective of, if we know we're going to make the gift. Now, for sometimes we may not know until the end of the year. We may not know if we have the assets or to what extent, which I get. But if we know we're going to make the gift, why not do it earlier and let the appreciation then accrue for the person who receives the gift? Also, too, this is certainly an intra-family tax planning approach, but to me, it's a very proactive approach, to the sense that we may have an estate tax exemption being reduced this year. And that is something that, as part of the taxes, everybody's talking about income taxes or, the corporate tax rate or the personal tax rate. But what we're not really looking at is, well, what's the estate tax situation going to be? And in the event that the estate tax exemption is changed and reduced, by getting rid of assets now, we're able to take a more proactive approach. But just looking at, how does this gifting really work? Well, it's very possible that you can gift the stock or a capital gains, in this case, to somebody that's in a 0% tax bracket. So, in this example here, we have a $1,000 stock purchase. So I'm back about 10 years ago, I make this purchase for $1,000. It's now worth 11 grand. So if I go ahead and sell it myself, I'm going to pay taxes at somewhere between 15 and 23.8%. This does not include any state taxes. So whatever, my state of Colorado is going to hit me with another, say $400 and some worth of tax. So the gifting option is, what happens if instead of me selling it, I gift this stock, and let's say in this case, my daughter would sell it. Given that she's in the 0% tax bracket for capital gains, she pays no tax. And so this is a situation where, for the family, we can end up reducing our tax rate. In this case, eliminating a tax bill. And here's some of as far as the capital gains rates, just so you can see where we are this year. For the single files over here in the blue column here, this 0% rate applies. And this is taxable income, but again, for the married couples, it's double that over here. So the 80,800 or 40,400. So if you have somebody that is making a relatively low amount of money, by gifting this intra-family, you may be able to pay nothing. Or even if you're paying something, it may be 15% instead of this 20% plus the Obamacare surtax. So anyways, it's a proactive approach because, again, we don't know what these numbers are going to be. We know that there's a sunset provision coming in so that if Congress does nothing, that in 2026, the estate tax exemption is going to go way down. It's going to be sliced in half or more so. It's very possible, though, that for 22, 23, 24, 25, the current Congress could come up with some other number. So you see this number coming from 11.5, 11.7. We'd look at something, around, and apologize for my ugly numbers here, somewhere around 11.9. We would expect it to be going up 12 million, somewhere around there. But we don't know. And so I think what we need to look at here from an estate planning perspective is, we don't know what the estate tax rate is going to be. We don't know what the exemption is going to be, and we don't know when we're going to die, right? And so when you put all that together, let's be proactive about it. And that's when the gifting comes in. So, all right, up on the screen, little text messages I hear from the government. The good news is here is that this isn't exactly true, but nobody really knows how much we know. It's always a big mystery with the taxes. Anyways, let's look at some of the other issues that we have as far as the changes go. Required minimum distributions. This is for those who are age 72 or older. These were eliminated for 2020. They have been reinstated for 21. I don't know if this is going to stay this way, but as of right now, you should plan on taking minimum distributions this year if you're required to do so. I would suggest also that you might want to consider taking these distributions anyways, even if you're not required to do so. Now, and this I think would apply to anybody over age 59 and a half. If you're under age 59 and a half, you're going to run into penalties if you take money out. We typically don't want to do that. But if you're over 59 and a half, let's say you're retired and you're going to be, you think you're going to be in higher tax brackets for the near future, you could look at taking some money out of an IRA today, because your tax rate is going to be lower today than what you think is going to happen in the future. In other words, you think taxes are going to go up, either for you or for everybody, or maybe both. So anyways, something to consider as far as timing options, and do you want to take these distributions? As far as contributions go, this is one of our rare instances of retroactive tax planning. And I'll give you an example of how this works in a couple slides, but this is not a typo here, in that you can continue to fund your SEP IRA right now for last tax year, okay, for the last taxable year. So if you did not fund a SEP, let's say, for 2020, you can still do so and designate the contribution for 2020 and get the tax deduction for 2020. Likewise, you can do the 2021 as well, and you can do them both at this time. So it doesn't hurt if you're working with a tax professional, and presumably a lot of you probably are, to get a really early draft of the tax return done, especially if you haven't fully funded a retirement plan for last year, to see, would it be beneficial in some way if you were able to fund it now? Would you get a tax deduction? Would it help you to reduce your taxes for last year? Do you want to forget it for last year and look for this year? Let's take a look at the tax planning for both years, since we can. Basically for 21, almost all the numbers stayed the same here. The SEP went up by $1,000. From 57 to 58,000, and that is the same as the 401k. So if you add up this 19.5 and the 38.5, you'll come back with this 58,000 as well. So 401ks and the SEPs went up a little bit, nothing on the simples or the IRAs as far as what you can fund. Now, I mentioned that you can fund some of these retroactively. For the 2021 year, for the year that we're in, if you want to do a simple retirement plan, and there's reasons why you may want this, especially if you, let's say, have a sideline business that's making a relatively small amount of money, it allows you to contribute a lot more to the plan. 401ks, we have till the end of the year. An IRA, we could even contribute to it next year. But of course, the sooner we contribute to it, the sooner we're going to get the tax deferral. Or if it's a Roth, the sooner we're going to get the tax-free status. So again, while we can establish the plan late, the sooner we do it, the better. So here's some retroactive tax planning. So we go ahead, I get my tax return, let's say, prepared next month sometime. Not that it means I'm going to file it, but I get everything prepared, and maybe I go as far as I can. I may not have a K1, or I may not have everything, but I get it pretty close. And my preparer comes back and says, "Hey man, you owe $2,500 on your tax return." So it's like, all right, that's kind of what I was figuring. But he goes, look, you make a $10,000 contribution to your SEP, and we're able to now get your income down by 10 grand, and we're now able to zero out your tax liability. So my options are that I forget the SEP and I pay 2,500 when I file the return and I move on, or I fund the SEP for 10,000 bucks. Now I'm going to fund it for 10,000. Either way, I was going to be out this 2,500, right? I was going to owe it if I didn't fund the SEP. So, whether you consider my investment 10 grand or 7,500, either way, I've got a pretty nice return on investment here. And then also remember that whatever happens with this 10 grand when I put it into the account, that is all going to be tax deferred until the money is withdrawn. So what happens if I would put that, into the next Apple, or the next Google or something, and that 10 grand turns into 10 million? That money is never, ever going to be taxed until I pull it out. Okay. And so we're getting all of this tax deferral all along. So retroactive planning gives us the option to be able to look at our tax bill today and do something about it, maybe contribute to the SEP. So anyways, throwing in a little Bill Murray here tonight. A little Caddyshack for us here for all the golfers and Bill Murray fans out there. But let's continue with the retirement plan stuff, with the retirement plan distributions. What do we do with it? I mentioned, you're over age 59 and a half. Let's say we have a low tax rate. Maybe we do consider taking a distribution this year, especially if we think that next year I'm going to make a whole lot more money, or I'm going to start selling rental properties and I'm not going to do a 1031 exchange, or I'm not going to do my rental property transactions in let's say a tax deferred account. There's a lot of different reasons why I may want to tax something today to lock in the lower rate. Now, again, I'm not suggesting that everybody goes out, take all their distributions, sell all of your assets and get a really big tax bill, right? But we need to look at what is your income in 21 with what are the tax rates in 21 relative to what do we think the tax rates and your income are going to be in 2022. Now, Don and I at the beginning here, we were talking about, do we think what are the tax laws? When are they going to change? We were assuming that, yeah, there's going to be some changes, but when are they going to take place? And I look back at the first year of the Trump presidency 4 years ago, and the tax deal, reducing taxes was a big part of the Trump platform that year. And even though the Senate and the House were both in the Republican control, it took until December of that year before the tax bill was passed, and it was not retroactive. So everything in 2017 became effective January 1st of 18. And that's what I think we're going to see this year, is that if there is a real big tax bill, similar to a real big overhaul of, what Trump did back 4 years ago, if Biden, first of all, wants to do that, and second of all, is able to do it, I don't think that that's going to take place until sometime later this year with an effective date of January 1st of 22. Now, that doesn't mean that I think that there will be changes this year that will be effective this year. But most of the time we don't see tax law changes that are negative, in other words, that affect us in a negative way, go retroactive. Now, again, there's no such thing as a certainty here with taxes. Yes, you will pay taxes. I guess that's a certainty, but what that'll be, hard to say. But we have to consider different possibilities as far as where we're going to be on the income stream and where we project the taxes to be as well. All right, let's look at some of the other personal tax planning for 21. The charitable contributions for public charities, so this is not private foundations, was raised last year from 60% to 100% of your adjusted gross income, meaning that you could effectively zero out your tax bill. You could have, instead of taking 60% of your adjusted gross income as the maximum, it's now 100%. So with planning, you could pay no taxes in 2020. And, if that's the way you were going in 2020, congratulations, you can do it again in 21. So the recent December bill extended this for 1 year, gives us another opportunity to greatly reduce our taxes through charitable giving. Let's see, health and dependent care. Rollovers typically are not permitted on these plans, but the December tax law is allowing us to roll over any of the unused amounts. And this is in any health care flex accounts and also dependent care flex accounts. So we can do that from last year to this, and then also from this year to 22. So lots of different options here. It's not a use it or lose it situation like it's been in years past. Again, I think giving us flexibility. Who knows what's going to happen with COVID and what the next stimulus checks are going to be. So, we're just going to have to, I guess, play it out. Okay. Looking now, capital gains. This is one of the possibilities on the Biden tax plan that gets very, very high. And I'll show you this in a few slides here, but we've got what are considered to be now historically low capital gains rates. And I don't see how, certainly they're not going to go down in 22. But I don't see how they're even going to stay the same. I think that the capital gains rates are going to be going up, and that's going to be both short-term and long-term. Short-term capital gains, I think you'll see an increase for those who make more than 400,000. That 400,000 of income seems to be the Biden tax plan, sort of that magic threshold number. And I'm not sure really where it comes from, other than it's the number, I guess. And so I think if you're making more than that, you're going to see a tax increase, certainly on the short-term gains and probably on the long-term capital gains. And when you get into a 7-figure income, you could see a considerable capital gain increase on the long-term rates. So we may want to look at some point this year locking in capital gains. Whether that happens to be, this guy over here that's paying 0% in these brackets, but maybe it's also a situation where you happen to be in this 15% bracket. So you're making somewhere between this 80 grand and 501,000. And you may say, well, my income is, could be over 400,000, or next year, this 15% tax rate could be 18%, or it could be 20%. But I'll bet it's not going to be lower than this 15%. So I may want to go ahead and sell some of this stock or sell some of these assets. So I could be in a situation where, let's say I sell some stock, I can turn around and buy the stock right back. So there's no problem as far as that goes. But it might be something where I reset my basis to take advantage of the lower capital gains rates this year relative to what I think they're going to be next year. All right, standard deduction amounts. This is an interesting part, and this is down at the bottom here. And that is that for both of these years, for 2020 and 21, you can also get an extra $300 or $600 amount if you're married filing a joint return. So if you take the standard deduction, so in 21 you can get this $25,100 plus another $600 on there. So again, you may want to look at bunching your deductions between 21 and 22. And granted, we just started 21, but still, it's something that you may want to look at as far as being able to plan to take advantage of and maximize the standard deduction. I mentioned the 100% rule on the charitable contributions, which obviously good news as far as what we need for planning purposes. This 7.5% rule for medical expenses, this rule has jumped back and forth from 7.5 to 10 to 7.5, and I can't ever figure out what year it is or what the amount is. The new law in December makes this 7.5% and makes this quote unquote permanent. So as much as anything in taxes is permanent, it's 7.5% now. So again, bunching expenses, if you expect to have a lot of medical expenses this year and you're going to itemize, you're going to want to look towards the end of 2021 to bunch more expenses in there. So if you needed, let's say, prescription eyeglasses, if you needed dental work, any sort of medical expenses that may be not an absolute necessity that you get them done right away, something to look into as far as bunching up these deductions. Big one here, and this is one that I think we're going to see sooner rather than later as far as this highlighted part, this potential law change goes. I really think that we're going to get rid of this SALT tax limitation. And what this limitation is today is that if you add up all of your state and local income taxes and your property taxes, so your real estate taxes on your personal residence, on a, if it's on a second home, your state and local income taxes, and once that hits $10,000, you're capped. And there are so many people. I mean, look at yourself in higher tax states: Illinois, New York, California, Massachusetts, and and the list can go on and on. There's another dozen states that are up there. People in these states are getting basically burned. They're getting ripped off in the sense that they don't get to deduct all these taxes that they could have in the past. And so I think that we're going to see this cap removed. And if that's the case, we want to make sure that we look at, when is this law retroactive? Or is it retroactive? Because let's say that this law is, there's a law that says we're going to remove the SALT cap and the $10,000 cap doesn't apply anymore. They could make that effective for 21 or for 22. And if it's going to be made effective for 22, then we want to make sure that we defer payments, let's say on income taxes, till January of next year if we can. So again, I think we're going to see this change happen, but we're going to have to make decisions about timing. And if you're self-employed, if you've got rental properties, if you've got investments where you maybe can buy and sell or incur expenses, defer revenue, that sort of thing, we may have a lot more flexibility here. But we're going to want to look at both what is our income and what is and what are the tax brackets. So what is our bracket, and what are the brackets going to be next year? And that's going to help us decide, okay, do we accelerate this income into this year to take advantage of what we think are going to be lower brackets? And again, we may find out, there's a tax law that gets passed in July that says income taxes are going up and they're effective for January 1 of 22. So we'll have some time to plan. But again, this is, the way I'm looking at this is let's think about it now. Let's keep these thoughts in the back of our mind because we're not really sure exactly how this is all going to play out. And the same thing, I think for businesses. What do we do with businesses just like as individuals? Higher tax rates possibly in 21, likely in 22. And I think that's going to impact both C corporations and flow through entities. So basically the difference between the two, C corp gets taxed as its own entity. So it files its own return, pays its own tax, currently pays tax at 21%. There's talk of that going to 28%, maybe something in the middle, but I could see the rate going from 21 up to something. The flow-through entities, basically anything else, S corps, most LLCs, partnerships, sole proprietorships. And there, I think we're going to see this QBI, this qualified business income. I think we're going to be seeing changes there as well. And the number that comes into play again is this $400,000 number. So that is something that if if your income looks like it's going to be higher than that from your business this year or next, we definitely have some planning to do. And you want to watch the tax laws to see, has anything changed as far as this qualified business income, this QBI? All right, some of the tax credits that came out of the CARES Act. Again, this was way back. When was that? Back in the spring of 2020. The new December additions to this now extends the employee retention credit through the second quarter of this year, and it also increases the credit rate from 50% of the wages to 70%. And the third point here, so not only do we have an extension of the date, we now can have an increase in the amount of the qualified wages, but also that the $10,000 amount goes from the year now to the quarter. So a lot of changes here that we can get additional employee retention tax credits. Real big for any businesses that have employees that are paying payroll taxes. So it definitely affects your 941 taxes. And the other thing that I found that was really very, very beneficial when I was going through this stuff, reading it over the weekend, was this part right here. And that is, whoops, that's a little sloppy, this 50 to 20% rule. So in the past, with the prior rule, if my business, let's say, had $100 of gross receipts from a quarter in 2019, I would have to show that those receipts were less than $50 in the same quarter of 2020 to get this credit. In other words, my gross receipts had to drop by more than half. Now, all I have to show is that $100 of gross receipts now drop to less than 80 instead of less than 50. So it's much easier to qualify for this. And then also, we're also allowing new businesses to look at part of 2019 to see if they can qualify for this credit as well. So that was something that was unknown the last time, is what do we do with the new businesses? Now we know that new businesses can qualify. Some of the other rules that came out of this, the refundable payroll tax credit, again, valid through the first quarter of this year, but also applies to those who have self-employment income. So that would be any Schedule Cs, sometimes single member LLCs will generate self-employment income. And so again, this is something the employee retention tax credit certainly can come into play. The PPP, Paycheck Protection Program, this has been extended, and it's real interesting here because how the government is going to follow this, is going to monitor all of this, I have no idea. But $10 million loans are possible. We're using it for payroll, rent, other necessary expenses for the business. The loans are eligible to be forgiven, and if they are forgiven, this is not taxable income. So almost every situation in the tax law, if you owe me $100 and I forgive it, I want a tax deduction for that $100. And so I'm going to send you a 1099 for the $100, and you have to report that as income, as debt forgiveness. Now there's some bankruptcy and personal residence, and there's exceptions to this, but that's our general rule. Here, the government is saying, look, we're going to loan you, let's say it was a $100,000 loan to a small business. And if this loan is forgiven, you don't have to pay tax on that $100,000. Now, the other part of this, something that I don't think, at least I didn't realize until I got into this a lot more, is the double dipping. I just mentioned it's not taxable income, but even if it's not taxable income, when it's forgiven, we get a tax deductions for the expenses incurred in obtaining the loan. So let's say it's a $100,000 loan and I incur $1,000 of expenses in obtaining that loan. I can deduct the $1,000 of professional fees, let's say, or whatever it is. And if the loan is forgiven, I don't have to pay tax on the 100 grand. So, there's a streamlined process here for the loans. And again, this all just came out in the last couple of weeks, but you borrow under $150,000. Think about this. All you're required to do is to submit a one-page form online. And the IRS, or whoever's going to be auditing this, is really only going to be looking at this if there's fraud or if you're using the proceeds for some sort of improper purpose. Now, improper purpose, I guess, would be something other than your payroll and your wages and rent and all of that stuff. But I'm not sure how this is all going to play out. So what it looks like to me is that if you can qualify to get this 150,000 or less loan, and you qualify for this loan forgiveness, and again, I'd want to make sure, go to the IRS website and see what is this one-page document that I need to submit. What is this paper form, so that I know, okay, I qualify for this, or no, there's no way in a million years I'll qualify, or that only applies to this type of business and not mine. So again, a possibility that you could get into this PPP, right, the Paycheck Protection Program, get a benefit of a loan, and also get very favorable tax results. It's something that you need to look at. Certainly, I think all small businesses do. And I think this particular cartoon is why I choose not to prepare tax returns anymore. But yeah, let's not pray that we don't get audited for any other reasons here, other than, we don't want to deal with it, right? But anyways, we'll move on here to business meals. This is a change for this year and next, 100% tax deduction. So we don't have to do that 50% limitation rule. Only applies to food that's from a restaurant. Okay, so not other, you go to grocery stores or whatever, that's not good. That's not going to work. Includes beverages on this. So obviously the goal here is to get business owners to go support restaurants that obviously have been hurting through COVID. Not lavish or extravagant on the meals. One thing to keep in mind with the business meals, and again, I'm not sure how this applies in the sense of, if I'm going to go out to have a business meal, I'm going to do it whether it's a 50% or 100% deduction. But I guess I could encourage more business persons to be doing business entertainment. But the point I want to make, though, is that this is only meals. So did not bring entertainment back into play. So as far as 21 and 22 are concerned, business entertainment is deductible at 0%. Okay, not deductible. Business meals, though, go from 50 to 100. All right, a few other changes here. Paying our children or any employees, as long as it's quote unquote reasonable, we can go up to this $12,600 amount without having any income taxes due for the children. Now, don't go paying the kids $12,600 even, right? Let's make sure that whatever you're paying them is reasonable based on their age, based upon what they're doing, how long it's taking, what are their abilities, how much is it manual labor? Is it filing? Is it what exactly is it that they're doing? But what we're doing here is that we're looking at ways to save money within the family. And so here, this amount that we paid, this $18,000 in this hypothetical, now the kids here are going to owe nothing. And this would be the same thing in 21 as well. The parents, though, whoever owns the business, are going to get the deduction for this $18,000. And so the family is going to end up saving money on taxes. Now, again, the work has to be legitimate. We're not just paying them for, some sort of an allowance or whatever. Has to be legitimate work. And these numbers obviously could be a lot more or a lot less, depending on what our 15 and 17-year-olds did, in this particular situation. Other numbers for business owners here, Section 179 stayed pretty much the same. Bonus depreciation, automobiles stayed the same. So Section 179 still gives us the opportunity to deduct up front a lot of business expenses that would have to be depreciated over time. And then the bonus depreciation gives us kind of another way to go about that. Again, not much really changing there. Where I think this is going to change in the business side, and again, this is on the flow-through entities, so not on a C Corp, but on an S Corp, or again, anything but a C Corp, really. I think we're going to see some changes in the phase outs, and the phase outs are going to be in the amount of income you make. So currently, depending on the type of business, there may be a phase out, there may not, and it may depend on the wages paid. There's the calculations get, I'd say, a bit complicated, but for the most part here, if you make a certain amount of money, making the 400,000 comes into play, and you have a service business, you may lose the ability to make this deduction. And so it's obviously going to have an impact on the type of business entity that you may set up or you may want to set up here in the future. And with this potential tax change, this $400,000 amount, you need to keep this in mind, that if you know that you're going to be in this position, and it obviously good position to be in, right? You're probably not wondering, where your next meal is coming from. You may not also think that you're quite a rich person either, but if your income is more than this 400K, you need to look at QBI. You need to look at, am I going to be phased out? And if so, is there a way around it? Maybe I have a C corporation, maybe I have a C Corp and an S Corp. I don't know, lots of different possibilities as far as the structuring goes, but again, it's something that we've got to wait and see on this one. If your income, I think, stays well under the 400,000, I don't think you're going to have a problem with the QBI unless that whole area is repealed. And I think if there's a repeal there's going to be a major tax bill to repeal it. And we're going to know about that one pretty soon. So I don't see that on the radar. And again, I think if your income stays under the 400K, you're going to be all right as far as what the QBI is, or probably what your personal tax rate is going to be anyways. Okay. Our intoxication here quote here, and I never did really understand this when I had my law firm and doing a lot of tax planning and whatever, is that people were real happy when they got a big tax refund. And I was always kind of like, oh, that's really not that cool, because the government had your money, they had your 10 grand all year and you could have been making money off of that. But I guess, the flip side of that, much better than owing. So anyways, let's try to get it right and get it close either way, so the government doesn't have a lot of our money in its bank account all year. So what I want to look at for the next few minutes here to end my presentation before I get into some of the Q&A is the tax tips. What do I think we should do? I think we need to look at our entity structure for anybody in business and consider timing options. When should I take the income? When should I take the expense? Should I depreciate it? Should I take 179? Should I use bonus depreciation? Be flexible, because the tax laws are going to change. We just don't know to what extent. I think we can plan on an increase for 22. And so we have to look at timing issues as we get into the third and fourth quarters of this year. Do we want to try to bring as much income into this year? Do we want to push back some expenses? Maybe we do, maybe we don't. But I think, again, by the time we have to make that decision, we're going to have a lot more knowledge. And likely we'll even have the new tax law, if there is one, in place by then. May not be effective till next year, but it'll be in place. Some of the other things I think are going to happen, this 39.6% tax rate, this is what it was prior to the Trump tax cut. And this is what it's going to be if nothing happens in 2026. So it'll sunset back into this. So I think you're going to see this bump up for those that make over 400K a year. I think we're going to see this cap eliminated, which is good. Not so good here. And I think, and this is not, a typo here, in that for people that have an income over $1 million, the long-term capital gains rates could go to ordinary income rates. Okay, so that could go back to this 39.6, and you get spanked for the investment income tax, the Obamacare surtax of 3.8%. So for those making more than $1 million, it's very possible that you could end up with this 43.4% rate plus your state rate. So you can see that, if your state tax rate is anything at, 6.5% or so, you could be at a 50% tax rate on a long-term capital gain. Now, if this does become the law, or what looks like it's going to become the law, those that are in this sort of a tax bracket that are making, quote unquote, a lot of money, had better look at making some sales this year and not waiting until the tax rates go up. All right, a few other ones here. Higher payroll taxes for those that make more than this 400K. So right now, your Social Security taxes start getting phased out, or excuse me, they get eliminated actually on the Social Security part at about, and I should know this, but I don't, around 140,000, 138,000, something like that. Under the Biden tax plan, that 140,000 would stay in place until you hit 400,000. And so there would be this donut hole type of situation where, let's say between 140 and 400, it would be zero, but between 0 and 140, and then anything over 400 would just be the 6.2. So something to look at there as far as wages go. I mentioned the higher corporate tax rate, increases on either a renter or first-time homebuyer credit and child and dependent care credits. So while these are going to be here, not necessarily good, right? Tax increases, these are tax decreases. And so what we're looking at is kind of a shifting of the priorities from the higher income to the lower income. I think other things that we need to look at for businesses for this year, we need to understand depreciation options. And I know nobody really wants to sit down and try to read depreciation laws, certainly myself included, but it's something that we need to understand our options. Do we want to do it in this year, next year? And again, this timing, accelerate or defer, real big issues as far as when are we going to be taxed and to what extent? And, I think I'll leave you with some of the other thoughts on, you need to consider other ways to make money that won't necessarily increase your current taxes. And again, if not for this year, then next, whether we're talking about municipal bonds, whether we're talking about opportunity zones and the ability to postpone or eliminate capital gains, talking about saving for college and obtaining tax-free savings, qualified small business stock, and getting an unlimited, basically up to $50 million of capital gains at no tax. So again, looking at ways we can make investments that are not going to trigger negative tax results. 1031 exchanges in real estate. What about investing in a retirement plan, whether it's an IRA or a SEP or a 401k, Roth or traditional, right? What about if we're starting to do index universal life insurance and other ways where the income is not going to be taxed in the current year. Annuities, oil and gas, health savings accounts, try to defer out as much as possible, or something like oil and gas, accelerate the tax deductions, savings bonds, whatever. I'm not, here obviously to give you to give you investment advice at all, but just look at ways that some of the investments kick off tax issues, whether they be, no taxes or whether they be maximum taxes. So, trying to figure all this stuff out, if Albert here can't figure it out, how are we supposed to figure it out? But, these are my thoughts as to, I think, where we're going to be this year, where we need to be, and maybe some thoughts on some planning for the remainder of this year. So anyways, that is my presentation for this evening. And Don, Kendall, if we have any questions, certainly be glad to entertain a few of those.
All right, Scott, thank you very much. Okay, we've got several questions. Kendall, if you can pop in here, mainly wanting to know how to get a copy of this recording. And I think those will be sent out to anyone who registered, but it usually takes about 24 hours. So don't get in a big rush. If you'd like to share this recording with others, you're welcome to do that once it's been emailed to us. But it usually takes a little while. Kendall, any comments on that?
Yeah. So generally, like I said, watch for the recording tomorrow sometime. We'll send that out. But I would highly, highly recommend going to YouTube. So youtube.com, type in the YouTube search bar, Protect Wealth Academy. You'll find us and all of our archive webinars there. Most of them are there now. And I would hit subscribe, because then once you subscribe, you'll receive notices of when those are posted. Again, not every webinar is there. Most of them are there. Not every time, but most of them will be. So I highly recommend that.
So they go to YouTube and then search for Protect Wealth Academy?
That's probably the fastest way to do it. Yes.
Okay. But you will also send out an email link to everyone who registered for this class. They can click on that link and that will still take them to YouTube.
Yeah. And any new videos we have, which by the way, we have new videos we're posting all the time now on YouTube. So subscribing is a good idea.
Okay, good. All right. Scott, how do I write off or calculate a home office for a home-based business?
Well, when you're doing the home-based business, you're basically going to take your square footage of your office and then divide that by the square footage of your home. And it can be a rental, so it can be an apartment or whatever. And as long as you're using the office regularly and exclusively, so you're not using it as a spare bedroom, but it's an office, then whatever that percentage is, let's say it's 20%, you would get 20% of your utilities and mortgage, rent, insurance, all that stuff as a tax deduction.
House cleaning, maintenance, repairs, anything on that home.
All that stuff. Yep.
Okay. That's good. Okay. Alan is asking, any chance of the stepped up basis going away? Between planning for step up basis for highly appreciated assets versus tax estate planning, which one do you save first? That's a good question. Any chance of you think the step up basis is going to go away? I know there's been talk of that.
Well, yes, I think absolutely there's a chance it could go away. If you go to President Biden's website, it talks there about eliminating the step up in basis for inherited assets. Whether he could get that through or not, I don't know, because right now, pretty much everybody who inherits assets, there's no estate tax because they're under the exclusion. Like the person that passed away would be under the exclusion, and when you inherit those assets, you don't pay any tax. Under the Biden proposal, if you don't get a step up in basis, you would get the basis. I guess it would be a very hard calculation on some of it. You'd have to go back to the person who died to get their basis for it. So yeah, if that becomes the law, then we've got a lot of different changes that we need to make.
Yeah, that would be a big one, and that is tied right to your, it can be tied to your estate taxes, and it depends on where the estate taxes go. Normally, if you have a choice, you normally pay the capital gains taxes, not the estate taxes. If
Right.
the estate's big enough, because the estate taxes are a whole bunch worse than the capital gains taxes.
Sure. But I think, the problem here is that if you know, let's say that we have a stock that we bought for $10, and now it's worth thousands of dollars because it's been held, we bought Apple on the first day and it's been held for years. We don't even know what our basis is. And then also you could end up with a big tax hit to the person who inherits the stock. And then they're going to try to figure out, well, what's my stock basis? How do I report this? Or maybe, who knows? I mean, but there's a lot of different people that will hold stock for a long time. And part of our strategy in the past has been, hey, let's not sell that stock if we don't have to. Wait till the person passes away. We'll get the step up in basis, and then we can sell it, or at least we know what the basis is at that point.
Okay. All right. James is saying, I thought, he's talking the stimulus package, obviously. I thought children for round one were getting 500 and round two was 600. Was that different than the way you described it?
No, I think that's right. In round two, everybody gets 600. So the parents and the kids, whatever, would get it as long as they're not in college. So it's under 17 years of age. And that's right. The first payment was $500 per child. That's correct.
Okay. Carmen, does unemployment income count toward total income?
Yes, it does. It's taxable too.
Yep. Akbar, if I had an AGI higher than 150 in 2019, but will be less than 150 in 2020, can I reclaim the full 600 per person married filing jointly?
Yes, and that's part of it too. Is that like I said, it's an advanced tax credit, meaning that you look at your 19 return, and let's say here that this gentleman's return was 400,000, right? He's way over the 150, so he doesn't qualify. Now he files this year's return, so you may want to file it early because you're going to get this money back, because let's say the 2020 income was 130, something under the 150, and now he qualifies.
Okay. All right. Next question. Do we need to have a written document or a memo of gift when we gift anything more than $15,000? Does it need to be written? Does it need to be notarized?
Well, I part of it, I think, would depend on the type, or like, what is the gift? Like if it's a gift of cash, where you're writing out a check, you could put on the memo line, 2021 gift, $15,000 or whatever. But if there's any valuation issues, then that would need to accompany the gift. Let's say it was 3 gold coins, you'd want to have a little gift. I hereby give you these 3 gold coins valued at $2,000 each or whatever. But it's something I think you want to keep it relatively simple, and just put yourself in the IRS's position that if anybody ever came back at you, would you be able to prove it?
Okay. Yeah, I think that's good. And I wrote a whole chapter in a book on present value interest if you were giving somebody an interest in a limited partnership or an LLC. And that's where it gets a little sticky. And then you need the crummy notice and you need everything else. But so to answer your question, just document the best you can, because you might have to back it up. And I think having it in writing is always a good idea, whether it's notarized or not. I think I agree with Scott. It depends on the gift. All right. If I give my niece appreciated,
being able to back it up.
Yeah, that's right. If I give my niece an appreciated stock, what is her cost basis?
Her cost basis would be the same as your cost basis. So there's no step up in basis on a gift of stock or any other asset.
So sometimes the best way to give somebody something is to die, and then they get a step up in basis, assuming that doesn't go away. But gifts, they inherit your basis in the asset. Okay, got it.
On a gift.
How does the IRS know I give $150,000 to my son? Good question.
I mean, well, you mean you give 150,000 to your son and you don't file a gift tax return?
Yeah, they know that because you filed a gift tax return.
Right, they would know it then, but if you don't file a gift tax return, then at some point that can come back to bite you for failing to file, or we don't know what the tax laws are going to be in the future estate exclusions, exemptions, all of this stuff. So, I guess it would be like anything else. So how would the IRS know if you don't file any return, right? Chances are at some point it's going to catch up to you. And I always recommend, whenever a return should be filed, I want to file it because it starts the statute of limitations for the IRS to do anything. And so, you don't file this gift tax return or whatever. And, 10 years down the road, somebody dies and now that wasn't filed. And now that becomes an issue for somebody. Let's just get the returns filed. And, there's not going to be a tax due on the gift tax return, assuming we haven't used up the exclusion. So it's just going to be the cost of preparing the return will be the only, quote unquote negative here.
I like the idea of anytime you're giving a gift more than the $15,000, you're required to fill out that gift tax return. And how does the IRS know? Well, it's going to be counted against your taxable estate when you die. Right now, that exclusion amount is what, 11.5, 11.6, whatever it is. But if that exclusion amount comes back to $1 million or 2 million or 5 million, you might have a problem and wish that you had filled out those gift tax returns. Okay.
That's right.
All right. Unless you're in a Roth IRA, yes. Looks like, does gifting apply to gains on a property sold? Does gifting apply to gains on sold property?
Well, you could sell property and gift the proceeds, but as soon as you make the sale, that's a taxable event. So if you wanted, you could gift the property to somebody else and let them sell it and they could pay the capital gains. That's a possibility as well. But the sale is going to trigger capital gains tax for somebody.
Okay. Good. Daniel's asking, I did not take the 2020 RMD, required minimum distribution. Is it too late to take it now?
That is a good question. I don't know the answer to that. I believe it is, but I don't know on that one.
Okay, good. Donna is asking, I have a solo 401k that I try to max fund each year between the employee, me, and the company contribution. Considering the growing government debt, isn't it a good assumption that tax rates will be higher in the future? If so, wouldn't it be better not to fund the tax deferred accounts and just pay the taxes now?
That is a really, really good question, because you can look at that one of two ways. The one way is you would incur the whatever it is now, right? You're not going to contribute to a 401k, so you're not going to get the tax deduction for it, and so therefore, the 50 grand you would have put in, you're going to pay tax on that 50 grand today at what presumably will be a lower rate than what it'll be in the future, right? So that part makes sense. I think the part that we're missing out on, though, is that once we get that money at 50K, let's say, today, so we get the tax deduction today at a lower rate, and when we pull the money out, it's going to be taxed at a higher rate right down the road, but we're missing out on all the tax deferral. And so If you're 65 years old and you're going to pull the money out when you're 67, not a big deal. But what if you're 22 years old and you've got 40 some years of tax deferral? I think about this time last year where, if you would have told me last year at this time, when I'm doing a webinar like this, that we're going to have a stock market collapse, we're going to have a pandemic, we're going to have multiple different tax laws that nobody's going to be able to figure out. And that's only in a few months. What's going to happen in years or decades, is really difficult to predict. But I think your question is really spot on, is that when do you want the money taxed and at what rate? And I think for any of us that are on this call tonight, I can't imagine any of us thinking that in 5 years, the tax rates are going to be lower than today. I just don't see how that's possible.
Right. All
Hey,
right.
Don, can I jump
Scott,
in
your
real
time's
fast?
up. Let's go ahead, Kendall.
I want to say, if you don't mind putting up, people were asking the question where to sign up for the summit. Maybe you want to show your slide that shows, I guess it's really just protectwealth.com.
Yeah, protectwealth.com and come to the summit. Scott will be there. He'll be teaching for at least a couple hours, different subjects and different presentation. Scott, I so appreciate you being on. Let's take two more questions, and then I apologize for everybody that we're not going to get to all the questions today. But Scott will be back with us in 3.5 weeks at the summit. We hope you join us for that. And this is a tip of the iceberg of what we teach at the summit. Oh my gosh, we've got some incredible people coming and lined up for you. All right, so is a SEP IRA only for earned income? You stated contribution.
Yes, yeah. Any of your retirement plan stuff is going to be based on earned income, meaning that you have to have some sort of services, employee, something along those lines. So you're going to have wages, you're going to have guaranteed payments, you're going to have something that is going to be earned income, correct?
Okay, good. Yeah, if you just have passive income, then you're not eligible to continue to contribute to the IRA. You have to have earned income, right?
Correct.
What if I only have $3,000 in earned income and a whole bunch of passive income? Can I only contribute the $3,000?
Well, yeah, your contribution is certainly going to be limited by the amount of earned income you have. Okay. So yes, that would be, you would be limited for sure.
Okay. Oh wow, Sandeep. For real estate professionals, if the real estate loses through accelerated depreciation exceed 2021 income from all sources, is a carryback loss allowed to offset them against prior year's income? So he's a real estate professional.
Right.
Yep.
For 2020, there was a carryback of losses permitted, but that was not carried into 21. And so normally those losses, you would zero them out and then they would carry forward. And so you wouldn't lose them, but you would carry them forward. And one thing that I would consider in this situation is not using the full bonus depreciation or the Section 179 if your income is relatively low, so that you don't necessarily want to zero it out this year, and then have those deductions available to you in 2022 or 23 or 24 when the income tax rates are higher. So consider that we may not want to accelerate the depreciation this year, although we need to know we have that option if we want it. And you can do it asset by asset. So you could decide to accelerate the laptop computer you bought, but take your forklift over 5 years or something. So you can decide what you want to do on an asset by asset basis. Again, trying to play the tax game so that you have the least amount taxed, at the highest rate, basically.
Okay. All right. And again, I apologize if we didn't get to all your questions. Our hotline is open tomorrow. It's where you just go to our website, protectwealth.com, and we can answer some of the questions. We're certainly not Scott Estill capable, but we can answer some of your questions on the hotline. And hopefully we will see all of you at the summit coming up. Again, the dates on that is February 22nd, 23rd, 24th. It's a Monday, Tuesday, Wednesday class. We know it's the week in the middle of the week, but remember the theme of the class: a lifetime to accumulate, 3 days to protect. Please, when you take the time off and come. If you haven't attended a summit, it will be worth your while to do that. We're bringing up an amazing set of lineup of speakers. Scott, thank you for your time. We know you have to go, and we've taken you further into the evening than we thought. I think that's it. I think that's all we got to do tonight. Thank you for being on. We appreciate all of you being here. Scott, thanks for your time. Any closing remarks, or are we ready to close it up?
I think we're ready to close it out. I think, the same that I would say to myself too is, hey, best of luck here. Let's be patient. Let's see what happens. And we're going to be flexible, and we're going to be ready for whatever they give us. So we'll just have to be patient and see what that is.
I don't think there has ever been a time in my life where tax planning is more important than it is now. So we appreciate you being on, appreciate you learning what you can, and yep, let's see what happens. Thank you all, and have a great night. Scott, thank you.